everyone, my name is Jack. I'm a 23-year-old real estate investor and soon-to-be attorney, and on this channel I cover a variety of topics as they relate to investing, the markets, real estate, and pretty much everything as it has to do with personal finance. So if you like that sort of content, be sure to have a look around the channel, and if you like what you see, be sure to subscribe. But today I want to talk about the Snowflake CEO, Frank Slootman, and his $1 billion payout from stock options that he's receiving every single year for the next 3 years. Because of where Snowflake's stock price currently is at, he is set to take home over $1 billion per year just from these stock options. But before we get into the details of this stock option package and how Slootman is actually being paid, I think it's important to understand first off what Snowflake is and what's happened to it, and then also how stock options actually work. But for those of you who don't know, Snowflake is a data analytics company that recently had its IPO, its initial public offering, back in September of this year. Their competitive edge, if it has one, is that it is a cloud-based data storage company. I don't want to get too much in the details of how it works, partly because I don't fully understand it yet. But generally, they're a big data firm, and they have some nice analytics software that is affordably priced compared to one of its main competitors, which would be Amazon Web Services, which currently has a pretty large market share. The company is worth something like $100 billion right now, and it's going up every single day, it seems like, because the stock has surged since its IPO in September. It initially IPO'd at a price of $120 per share, and it's currently sitting at about $380 per share after it popped about 10% today. The company just had its earnings report, and it's still losing money at about $1 per share, but its revenue has grown 200% year over year, so they are in big time growth mode right now and are still on that path of what many tech firms are facing right now. Very low profitability, often taking very large losses at the beginning of their life, but really going for growth and trying to gain as much market share and traction as possible. Investors are pretty bullish on all tech firms right now, and Snowflake is no exception. In fact, it might be one of the leaders. Now, Frank Slootman, who I mentioned earlier, he is the CEO of Snowflake, and he joined back in April of 2019. He actually receives a base salary of $365,000 per year, which would be quite life-changing money for just about anyone. So that's his base salary that he negotiated when he first joined, again back in April of 2019. But as part of his pay, he also asked for an additional package of options to be given to him every single month for the next 4 years after he started. So every single month, he receives a package of a ton of stock options at a strike price of $8.88. I'll explain what that means in a minute. And he's going to keep getting them until at least April or so of 2023. Now, I want to explain how options work, since they can be kind of tricky to understand, and it's important to understand it for how he's actually getting paid here and how he could actually be earning even more than the $1 billion or so that he would be netting if everything goes smoothly from here. A stock option is a contract, and the contract gives you the right, but not the obligation, to buy or sell a share of a stock at a given price. Stock options come in two flavors, a call option and a put option. You can look at it this way. For a call option, you really need the stock price to go up. For a put option, you need it to go down. And you need it to get above or below what's called the strike price of the option. The strike price is where the option becomes worth something at expiration, because all stock options have an expiration date. The longer term the option is, the more expensive it's going to be. The shorter term, the less expensive, since time is a risk. The less time you have, the less time you have for the stock to reach whatever that price is you need, and that's a risk. Now, because Slootman is the CEO and decisions he makes would have an impact on the company, they want to encourage him to push the stock price up. So they give him call options, not put options, since if they gave him put options, he would want to push that stock price down, and that's obviously not good for the long-term health of the business. So his stock options have a strike price of $8.88 per share. This means that as long as Snowflake stock is over $8.88 per share, he can buy 100 shares per contract of Snowflake at $8.88 per share, even if the stock price might be way higher than that. So he gets an instant profit if he executes the option. And you heard me right, every single contract gives you the right to buy 100 shares of that stock at that price. So they have a massive multiplication effect. This makes them drastically more profitable potentially than something like just buying a stock straight up, since you have the 100 shares built in to an option if you can exercise it. There is a big risk that you can't if you don't reach that share price. That was an admittedly simple explanation of how stock options work, but it should get us far enough to where we can figure out how exactly he's being paid. So Snowflake stock is at $380 per share as of today. It could go up, it could go down from there, but remember the strike price on his options is only $8.88 per share. So he has about $370 of room there. So if we do some quick math, that's $370 per share times 100 shares per option contract, and that leads us to a net profit of So every single month, he's getting a batch of options worth about $100 million. That's per month, and he gets that for the next few years. However, there is a catch. He can't exercise all of these options immediately. Some of them he has to wait for, but he can exercise a lot of them, meaning he can buy Snowflake stock at $8.88 per share with a lot of his stock options. But he hasn't exercised any of those options yet. He frankly doesn't need to, and he has some time left before they expire, it seems like. And another reason he hasn't done this yet is because the shares that he would get from the option don't actually vest until March of 2021, at least at the start. And they vest over the 4 years of this contract that he signed. In other words, he can't actually sell the shares that he'd get from the option until March of 2021 in a best case scenario, and I'm sure many of them have later vesting dates as well. But theoretically, he could start cashing in big time come March, so he is in a very good position to say the least. But what would happen if Snowflake stock just went sideways? It didn't gain or lose any value for the next 3 years. If by early 2023, Snowflake stock is at its current price of about $380, then that means that Slootman's stock option package would be worth $4.5 billion. And Snowflake could double in price from here on out. They're a growth company right now and seem to have a lot of tailwind at the moment. They are losing a lot of money, so there's a risk that that doesn't pan out. But still, you would think that it would at least go sideways or would hover around where it currently is. And even if it loses half of its value, he's still netting a couple bill. So that's a ton of money for just one guy to take in from stock options alone. So long as Snowflake stock stays over $8.88 per share, he will be in a very good place. But I'm certainly curious to see how high this can possibly go, because it seems like there's a lot of room for Snowflake to grow in its share price, especially if they turn profitable anytime soon. He'd be netting an unreal payday from these stock options. Anyways, that's all I've got for today. I thought this was an interesting piece of news, just seeing how executives can be compensated in many cases. He's not the only one at Snowflake getting lots of options and leading to massive paydays in the future, assuming all goes at least decently. But I hope it was also helpful for understanding how options work, at least in the basic sense, and how they can really multiply returns, even though they are more risky if you're trying to invest in them. But now you know how they work, hopefully, and you're seeing an extreme example in the wild. But if you like this video, please like it since it helps the channel out a lot. And if you like this sort of content about investing, the markets, real estate investing, and pretty much everything as it has to do with personal finance, be sure to subscribe since I put out new videos every single week and wouldn't want you guys to miss out. And check out my links in the description for free stocks from Webull and Robinhood. If you sign up using my links, we both get free stocks, so it's a win-win. Please do it since it's free money and it might not be there forever. So yeah, please do it. But until next time, take care.